Hi, this is Samira Simowitz doing my financial analysis using ratios. I chose to do my analysis based on Starbucks. So to assess their financial position, I'm going to be comparing Starbucks' profitability, asset management, liquidity, debt management, and market value ratios to those of Dunkin' Donuts. Starbucks was started in Seattle, Washington in 1971 and has since expanded all over the world. They offer an extensive menu of premium coffee, handcrafted beverages like their famous Frappuccinos, fresh hot and cold food, and merchandise. The Starbucks annual report from 2018 shows that the company is currently very successful and profitable. Their revenue increased by 10% from 2017 to 2018. They opened 1,997 new locations worldwide, and the average amount spent on each transaction increased by 3%. In terms of industry trends, Starbucks is ahead of their competitors. They put a strong focus on their social and environmental impact by offering new lids that can be sipped from and don't require a straw. They don't use styrofoam cups, which aren't biodegradable. They use ethical sourcing to get their products, and they help their communities, local and global. One trend where Starbucks may not have the upper hand is pricing. They are more expensive than their competitors, though it can be argued that the quality provided makes up for that. One of Starbucks' most prominent competitors is Dunkin' Donuts. Dunkin' was created in Quincy, Massachusetts in 1950, 21 years before Starbucks was created. They have also expanded to be a global company. However, they only have about one-third as many locations as Starbucks. They're most widely known for their coffee and donuts, though they also offer a breakfast menu and some other drinks. Dunkin' Donuts also sells merchandise, but their selection is much smaller than Starbucks. Going back to industry trends, I believe that Starbucks has the upper hand. Dunkin' does not put as big of an emphasis on environmental impact. They still have beverages in styrofoam cups, and there's no discount for using your own reusable cup like there is at Starbucks. Starbucks also has options for recycling in their stores, whereas Dunkin' only has trash cans. Dunkin' Donuts does have the advantage of being more affordable than Starbucks, especially for people who stop for coffee every day. Just a note as we move forward into the financial ratios, everything regarding Starbucks is going to be written in green text, and everything regarding Dunkin' Donuts will be written in pink, just to make it a bit clearer. The profitability ratios that I've worked out here are operating margin, profit margin, return on total assets, basic earning power, and return on common equity. I've bolded the company under each that seems to be more successful based on that ratio, and I'll go into a deeper analysis of that later on. So operating margin shows how much the company is earning in profit for every dollar that it makes. By dividing operating income by revenue, we can see that Starbucks has an operating margin of 0.157 and Dunkin' Donuts is 0.312. This means that for every dollar that Starbucks takes in, they earn about 16 cents in profit, and for every dollar that Dunkin' makes, they earn a profit of about 31 cents. However, as explained in the textbook, there are a lot of things that, like taxes, that are left out, so it's not a perfect representation. Profit margin divides gross profit by sales to show how much a company is earning through its sales. Starbucks has a gross profit margin of 0.58 and Dunkin' has a gross profit margin of 0.89. Return on total assets shows how efficient the company is in terms of using their assets to generate income. By dividing net income by total assets, we can see that Starbucks has an ROA of 0.187 while Dunkin's ROA is 0.07. Basic earning power is very similar to ROA and divides earnings before interest and taxes, or EBIT, by total assets to give a more comprehensive look into how a firm uses its assets to generate income. Starbucks' BEP is 0.214 and Dunkin's is 0.134. Return on common equity is the final profitability ratio. It measures how effective a company is at turning equity into profit by dividing net profit by equity. Starbucks has a return on common equity of 3.84, while Dunkin's is negative 0.32. Now I'll move into asset management ratios, which include inventory turnover, days sales outstanding, fixed asset turnover, and total asset turnover. The inventory turnover ratio expresses how often inventory is used or sold in a certain time period. By dividing cost of goods sold by average inventory, we are able to determine that Starbucks has an inventory turnover ratio of 7.27. Unfortunately, I couldn't find any information about Dunkin's average beginning or ending inventory, so I wasn't able to calculate that one. Days sales outstanding looks at a company's ability to collect on its accounts receivable. To calculate it, we divide accounts receivable by average sales per day. Starbucks has a DSO of 10.2, whereas Dunkin's is 21. Fixed asset turnover looks at the business's ability to generate sales with fixed or non-current assets. We divide net sales by average net fixed assets and see that Starbucks has a fixed asset turnover ratio of 4.9, while Dunkin's is 0.45. Total asset turnover, on the other hand, looks at how well a company uses all of its assets to generate revenue. It divides net sales revenue by average total assets, and we get a total asset turnover ratio of 1.023 for Starbucks and 0.38 for Dunkin'. The two liquidity ratios are the current ratio and the quick ratio. The current ratio uses current assets and current liabilities to determine whether or not the company is able to pay off their short-term debts. Dunkin's current ratio of 1.5 is a little on the low side, while Starbucks is at a bit of a safer 2.2. Quick ratio determines if a company has the cash or assets that can be converted to cash to pay off debts immediately. Cash and cash equivalents, marketable securities, and accounts receivable are added together and divided by current liabilities to get this ratio. Starbucks has a quick ratio of 1.69, and Dunkin' Donuts has a quick ratio of 1.24. The debt management ratios that I'm analyzing here are total debt to total assets and times interest earned. Total debt to total assets divides total debt by total assets to determine if a company can pay its long-term debts. The debt ratio for Starbucks is 0.95 and Dunkin's is 1.2, meaning its liabilities are actually greater than its assets. The times interest earned ratio shows whether or not a company will actually be able to meet its debt requirements. The company's earnings before interest, tax, depreciation, and amortization, or EBITDA, is divided by its interest charges. Starbucks has a times interest earned ratio of 34.94 and Dunkin's is 3.4. And finally, the market value ratios are the price to earnings ratio and the price to book ratio. So the price to earnings ratio divides the market price per share by the annual earnings per share to estimate the value of the company. Starbucks has a PE ratio of 21.33, while Dunkin's is 28.21. Price to book ratio compares a business's current market price to its actual book value. The share price is divided by the book value per share. Starbucks has a PB ratio of 21.14, and Dunkin' has a PB ratio of 9.51. So now we can use all of these ratios to determine if Starbucks truly is doing better than Dunkin' financially. None of these ratios by themselves are a perfect measure of financial health, but we can see there's a lot more green than pink on these two slides. Generally, most of the ratios favored Starbucks. Regarding the profitability ratios, higher means better for all of them. Dunkin' Donuts has a higher operating margin and profit margin, though the operating margin excludes a lot of important data and only focuses on revenue, and profit margin isn't meant for a comparison between two companies, as explained in the text. Starbucks has a higher return on total assets, basic earning power, and return on common equity. ROA, however, is also not meant for comparing companies, and it leaves out financing information and the actual market value of the assets. The fact that Starbucks has a higher basic earning power means it would be preferable to an investor because it generates more income from assets, and similarly, the higher return on common equity is preferable as well. Some data was missing online for the inventory turnover ratio, but the other three asset management ratios favor Starbucks. Starbucks has a lower DSO, meaning they face less risk with their accounts receivable. Starbucks has higher fixed and total asset turnover ratios, meaning they are able to use their assets to generate revenue more efficiently. Looking at the liquidity ratios, both the current and quick ratios show that Starbucks is in a safer position when it comes to paying debts. For those ratios, higher is better. According to the total debts to total assets ratio, Dunkin' Donuts has liabilities that are actually greater than its assets. Dunkin' Donuts does have a more preferable price to earnings ratio than Starbucks. According to the text, a higher PE ratio means that a company will generally have more value as long as the prices are actually fair. The price to book ratio, however, shows that Starbucks is valued at much more than its relative book value than Dunkin' is. In the company overviews, I predicted that Starbucks is financially doing much better than Dunkin' Donuts, considering its size and consideration for environmental and social issues, as well as its larger, more premium menu and merchandise selection. Based on the information provided in the ratios, I do think that Starbucks is in fact in a better financial position. And here are my references, which include the annual financial reports for Starbucks and Dunkin' Donuts, the text provided in the class, the Starbucks company profile, and macro trends, where I found a lot more financial information. Thank you.